This is Matt from InvestiQuant. Today is Wednesday, March 10, 2021. You know, I've been noticing something here recently in the markets. We were talking about it in the room this morning about how we've been seeing a lot of late day sell-offs taking place. And I was a little curious about it, so I figured what we would do this afternoon is just go ahead and quantify it and see if there is legitimacy to what feels like has been a sell-off that's been taking place a lot more frequently than what used to take place late into the day. So we're just going to do a simple study here just based on year-to-date data, and that's something that we can do easily here within Discover. And we're going to just look at all days year-to-date, what has been happening as we approach the close. So let me go ahead and set that up, show you how to do a custom look-back period here. I've got all four instruments included now. I'm going to use an intraday time-based entry near the end of the day, so we'll do 3 p.m. set up as a long, and then to look at just what has taken place this year, because it does feel like a more recent phenomenon that's been taking place. I can go into this date range. This is where you could do like in and out of sample type testing if you want to look at certain dates but exclude other dates. You can do all of that within the calendar section here in the Discover platform. So I'm going to go down to custom range, and I'm going to select January of 2021. We'll go January 1st of 2021, and we'll run the data just through today. So we're just looking at what's taken place here in about 2.5 months worth of trading. So I've got that selected, and that is all that we're going to be looking at. I've got a custom date range, and we're going to be looking at what has happened historically this year, entering the market long at 3 p.m. So let me go ahead and hit view results. And here we go. So this quick test is based upon 45 trading days that we have had so far this year, and it's simply entering the market long at 3 p.m. Eastern time. And it looks like had you done that every day this year, you would have gotten ran over the majority of the days. This has been a very weak time period so far this year, and these things change over time, but this year it seems like it's been really noticeable, and you can obviously see it here in the stats that it has been a weaker period here year to date. So the S&P 45 samples, 31% of those have ended up closing higher than that 3 p.m. price, and the average loss larger than the average win there. For the NASDAQ, 38% of those have closed above that 3 p.m. price. The majority of them are finishing lower. Average loss larger there than the average win. The YM, which is the Dow futures, very similar to the NASDAQ, where only 38% of those have closed above that 3 p.m. price, and the average loss has been larger than the average win. And then the Russell is the one that's closest to a neutral reading on the win rate at 47%, but the average loss quite a bit larger than the average win. So just looking at trading one contract here at 3 p.m. Eastern time every day this year. So this would be 45 trades of one contract in the ES. Had you done that every day, you would have lost $11,000 prior to any slippage and commissions on top of that. So pretty weak period that's taken place here so far this year. So I thought that was interesting. I figured I would share it with you, and hopefully you found it helpful. So good luck today, and we will see you next time.